Good afternoon.
Good afternoon, sir.
We'll start now. So we are in the accounting analysis lesson. So under this, we completed analysis of investing activities. There we focus on assets. So today's topic, analysis of financing activities. So here we are focusing on companies' finance. You know, financing, company can use two types of financing: debt financing and equity financing. Debt financing and equity financing. So in this, by doing this analysis, so we are trying to see whether these financing activities results are correctly recorded in financial statements. Or in other words, so we are going to check whether our financial statements fairly reflects the results of companies' financing activities. Right. So that's our forecast. So in this lesson, we'll first consider debt financing. So these are borrowings. Then we'll move on to the equity financing. So after completing the lesson, we'll move on to a tutorial. Right. So we have 3 hours. So we can do the tutorial also. Right. So this is the basic financing theory. So you finance different types of assets. So the basic theory is current assets should be financed from current liabilities. Then non-current assets should be financed from non-current liabilities plus equity. But depending on the company's attitudes towards risk, company's risk attitudes, there are situations part of the current assets are financed with long-term liability. Right. You know, some companies are not willing to take high risks. Right. So if you are going to finance all your current assets from current liabilities, it's risky. because your current liabilities proportion is higher. So when you face some cash flow difficulties, so you find difficulties in paying your current liabilities. So that involves risk. So if you finance your entire current assets or working capital from current liabilities, it involves to a certain extent some risk. So if the company is not prepared for such risks, so what the company does is part of the working capital is financed through long-term financing. Right. So we call that conservative policy. But this is a basic finance, investment and finance theory, financing theory. Right. And you know, the financing sources you can classify as internal and external. So both internal and external financing sources involve cost. For example, when you go for leases, bank overdraft, loans, when you issue debentures, you have to pay interest. And there are some issuing costs. There are some costs involved in getting loans, leases. So you see, external financing involves some explicit costs, like interest, loan arrangement fees, debenture issuing charges. But internal financing sources involves implicit cost. Implicit costs such as opportunity costs. Opportunity costs. So both financing sources involve cost. Right. Now let's see the accounting for liabilities. So the general rule is current liabilities you have to record at maturity value. So usually this is settlement value. Settlement value. But non-current liabilities, you have to record at present value. So this general rule is in accordance with SLFRS 9. You know, there are some current liabilities coming under financial instruments. For example, trade payables is a financial liability. Trade payables, financial liability. Right. So some current liabilities are financial liabilities. Some current liabilities are financial liabilities. For example, trade payables. It's a financial liability. So you have to record that settlement value. You have to record that settlement value. Now that's according to the IFRS 9. For example, let's say you bought rupees 1 million value of goods. So let's see simple example. Let's say you have bought let's say 100 units. Let's say 1 unit price is 1,000. So you have bought 100,000 goods on credit. Let's say supplier gave you discount at the rate of 10%. Then your discount is 100,000 into 10%, 10,000. So the settlement value is 90,000. So this 90,000 goes to the trade creditors. This 90,000 value goes to the trade creditors. So likewise, current liabilities has to be recorded at settlement value. So that's according to SLFRS 9. In addition, many current non-current liabilities are financial liabilities, like bank loans, debentures. So those are financial liabilities. Now, according to IFRS 9, they should be recorded at amortized cost. They should be recorded at amortized cost. Right. They should be recorded at amortized cost. Amortized cost represent the present value of cash flows. Amortized cost represent present value of the cash flows. Present value of the settlement cash flows. So we studied last time. And I have also asked you to study SLFRS 9. Right. Now you have the idea. Right. Now you see, when and long-term or non-current liabilities are recorded at amortized cost, according to SLFRS 9, that represents present value of the related cash flows. Now you see, if the company has applied SLFRS 9, then you have the confidence that the liabilities are correctly recorded in financial statements. So if the company has correctly applied SLFRS 9, so you have more confidence that the financial liabilities are fairly represented in the financial statement. Right. So this is a general rule. Current liabilities should be at maturity value. You see the general rule. Current liabilities at maturity value and non-current liabilities, particularly financial non-current liability, should be at present value. Right. So this general rule you have to check in your financial statement. So you check whether current liabilities are recorded at maturity value. So maturity value represents the settlement value or settlement price. Then you check whether non-current liabilities are recorded at present value. Present value. So this is what you have to do in the accounting analysis. When you analyze liability, you go and check current liabilities, whether they are at the maturity value. Then non-current liabilities and check whether they are at the present value. And the next point is, this is very important point. There are situations your non-current liabilities are, so you have to reclassify non-current liabilities to current liabilities. So these are the two main situations you see. The non-current liabilities have to be reclassified as current liabilities. So one situation is when debt covenants are not met. So if the company cannot meet the debt covenants, so debt covenants mean the terms and conditions agreed when you are getting debts. The terms and conditions you agree with, for example, if you are getting a bank loan, you agreed with the bank certain terms and conditions. You agree with the bank certain terms and conditions. So one condition is your repayments are monthly on 31st. That's one condition. So if the repayments are delayed, there's a late fee, late interest. That's another terms and condition. And another terms and condition would be during the loan period, you can't pay dividend. Another example, during the loan period, you have to maintain the current ratio at, or minimum current ratio during the loan period is 1.5. Now you see, these are examples of debt covenants. Debt covenants. So these are terms and conditions you agree with the other party when you are getting loans, when you are borrowing. We call debt covenants. So if the company breached the debt covenant, then for example, let's say a company breach debt covenants relating to a bank loan, then a bank will demand your money quickly. So if the bank feels that the company find difficulties in paying debts, then bank will demand money quickly. So in that situation, you see that bank loan becomes payable within a shorter time period. That bank loan becomes payable within a shorter time period, sometimes less than a year, then it's a current liability. It's a current liability. So in the accounting analysis, when you analyze liabilities, you check whether a company fulfill those debt covenants. Right. So you have to check whether a company fulfill those debt covenants. So if the company breaches debt covenants, then what happens is if it is bank loan, the bank may decide to collect money quickly within a shorter time period. Then your long-term liability becomes current liability. Right. Now you see the note. So I have explained in the notes the meaning of debt covenants. You see, debt covenants are conditions you agree when you are getting or when you are borrowing. Right. So those are some conditions you agree when you borrow money. You see examples. These are examples. Minimum working capital requirement. The bank will say during the loan period, you have to maintain the current ratio at 1.5. For example, the bank says quick ratio has to be 1.2 during the loan period. Right. At least 1.2. So this is a minimum working capital required. Then you have to fulfill that condition. So you should maintain at least current ratio of 1.5 in that example. You have to maintain at least current ratio of 1.5 and a quick ratio of 1.2. Because the bank has insisted you to maintain this minimum working capital requirement. Now the example, restrictions on dividend payment. Sometimes bank says during the first 2 years of the loan, you can't pay a dividend. So bank will say during the first, now the example, bank may say during the first, let's say 2 years of the loan, the maximum dividend per share is rupees 10. Now you see, these are examples of debt covenants. The purpose is to ensure company can continuously repay the debts. So bank put these covenants. The bank will put these covenants to ensure the company can continuously or timely repay debts. So if the company breaches those debt covenants, then bank may feel that the collection is more difficult from the company, or company may not have enough resources to pay debts. Then bank will quickly take actions to recover those loans quickly. Then your long-term liability becomes current liability. So in the accounting analysis, you have to see whether company has fulfilled the debt covenants. So practically what we do is we study the loan agreements. Loan agreements. If it is debenture issue, we study those documents. documents relating to the debenture issue. Right. And some of these covenants are disclosed in the financial statement. If you see the financial statement notes, you can find such debt covenants. Then by studying those, you can understand what debt covenants company has to fulfill. Then you check the financial statements and see whether those debt covenants are met. But if they have been breached by the company, then you have to see whether those debts become current liabilities. Right. So this is very important. And the second situation is going concern problem. So when there is a going concern problem, then your long-term liabilities become current liabilities. Long-term liabilities become current liabilities. So you have studied this in auditing. In your second year, maybe in third year, you studied this. You studied how to detect going concern problem. There are some indications of going concern issue. You studied that. So you should apply that knowledge here. Right. You see whether there are some indications of going concern issue. Then you see whether company has resources to face that issue or recover from that issue. So you have studied in auditing. So you apply this knowledge here. So you have to apply that knowledge here. Right. So mainly in these two situations, your non-current liabilities may have to be reclassified to current liabilities. Your non-current liabilities may have to be reclassified to current liabilities. Right. Now you see, if the company breaches debt covenants, your non-current liability becomes current liability. Right. So these are the key points you should apply when you analyze liabilities. Right. So these are the two key points. So you see the valuation of liabilities. You see current liabilities at maturity value, non-current liabilities at present value. So there are many current and non-current financial liabilities. Then you have to check whether those have been recorded according to SLFRS 9. Then the next important point is reclassification of non-current liabilities to current liabilities. Right. Right. Now we'll practice some examples. So we'll see first debentures. Debentures. You know, debentures are issued at par value. So par value is nominal value. Sometimes debenture issued at a premium. You have studied this in financial management. So when the issue price is greater than par value, so that difference is called a premium. Sometimes debentures are issued at discount. When the issue price is less than the par value, we call a debenture is issued at a discount. When you are accounting for debentures, debentures are financial liability. Debentures are financial liability. Therefore, you have to apply SLFRS 9, financial instruments. You have to apply this accounting standard, SLFRS 9. SLFRS 9 says, so you have to record long-term financial liabilities like debentures at amortized cost. Amortized cost. Last time we studied this concept, amortized cost. We studied last time. Right. So amortized cost represent present value of future cash flows. Present value of future cash flows relating to the debentures. Now you see it's according to this general rule. Debentures are non-current liabilities. Debentures are non-current liabilities. So non-current liabilities has to be in the financial statement at present value. Now you see if the company has followed IFRS 9, then your debenture value has been fairly recorded in the financial statements. Right. So you can accept that value for your analysis purpose. Right. Now let's see a simple example. So you come to this example. Right. So you do not write anything in this study material because I have uploaded this material into your LMS. So you can download this material plus a tutorial with a worksheet. So I have uploaded 3 documents. This study material, tutorial, number 4. And for that tutorial, we have a worksheet. Right. Now let's see this example. Now let's say company has issued debentures. The nominal value is 1,000. Coupon rate 10% paid annually. Debenture mature in 5 years. And issue price 1,090. Now you see, issue price is greater than the par value. Issue price is greater than the par value. So debentures, now you see here, debentures have been issued at a premium. Debentures issued at a premium. Right. Now let's see the accounting part. right? So nominal value is 1,000. Debenture matures in 5 years. Now let's see the cash flows. So now you have issued today. Right. So you receive 1,090. Now you receive 1,090. Then debentures matures in 5 years. You know, debenture cash flows are two types. You studied in financial management. Coupon plus maturity value. So coupon rate here 10%. Coupon rate 10%. Then first year company has to pay coupon 1,000 into 10%, 100. Second year company has to pay coupon. Third year, fourth year company has to pay coupon. So when the debenture is matured, company has to pay maturity value. So maturity value is the nominal value. Now you see in the fifth year, company has to pay coupon plus nominal value. Now these are the cash flows. These are the cash flows. To record these debentures, according to SLFRS 9, you have to find the effective interest. Effective interest rate. You have to find the effective interest rate. Effective interest rate. Last time we studied effective interest rate calculation. So you find IRR. IRR of these cash flows. Right. IRR of these cash flows. Now you see IRR 8%. 7.76%. So with the IRR function, you can easily calculate IRR. Now using this IRR, you have to record these debentures. Right. Now let's prepare the amortization table. We'll prepare amortization table. Here, coupon, interest, then coupon payment, so let's add the first column is beginning balance. Beginning balance. Then interest expense. Then coupon payment. Then end balance. End balance. So first year beginning, so debenture issued at 1009. Fair value of the debentures 1009. Then first year interest, this beginning balance multiplied by effective interest rate. Beginning balance multiplied by effective interest rate. Right. So let's round up to a full value. Right. So you issue debentures at 1090. Then debentures are initially recorded at issue price 1090. So that's the fair value. Then first year interest has to be 85. Beginning balance multiplied by effective interest rate. But you see first year coupon payment 100. First year coupon payment is 100. Then end balance equal beginning balance plus interest minus first year payment 100. First year payment 100. You see end balance 1075. Right. Now here we'll say this column payments, because we have not only the coupon, we have maturity payment. So let's see payment. Then at the end of the first year, the debenture value in your financial statements 1075. Now let's prepare the financial statements. Right. So we have 5 years here. So in the statement of financial position, one minute please. Right. So in the statement of financial position, under non-current liabilities, debenture value in the first year, 1,075. The debenture value in the first year, 1,075. You see, first year in value, 1,075. First year in value, 1,075. Then in the statement of income, the interest expense in the first year, you see 85. So this interest expense goes to statement of income. First year interest expense 85. Right. Now this is how the debenture transaction should appear in the financial statements. So you have issued debentures at the beginning of the year. Then a debenture in value, you have to calculate at amortized cost. So this is how it's calculated. Beginning value plus interest minus any payments. You see, in the first year, you have paid 100 coupon. Then debenture end value 1,075. So this end value goes to statement of financial position. Then debenture interest 85, that goes to the profit and loss. That goes to profit and loss. Now you can see this 1,075 equal to present value of future cash flows. You can calculate and see. This 1,085 equal to present value of future cash flows. Now we are at the end of the first year. You see, we are at the end of the first year. Now what are the future cash flows? Second year, third year, fourth year, and fifth year cash flows. We are at the end of the first year. Then future cash flows are second year, third year, fourth year, and fifth year cash flows. Now you can take the present value of these cash flows. You can take the present value of these cash flows. Right. Second year coupon 100. Third year coupon 100. Fourth year coupon 100. Fifth year you have coupon plus maturity value. Now you can take the present value of these cash flows at effective interest rate. So you can apply NPV function. NPV function. Rate, you see NPV. You see rate is effective interest rate. Values are these four values. Values are these four values. Now you see answer 1,074.59. You see the answer 1,074.59. So that's almost 1,075. Almost 1,075. Right. Now you see, if the company applies IFRS 9, the company's financial liabilities are recorded at present value. Company's financial liabilities are recorded at present value. Right. Now let's see the second year. Let's see the second year. Year 2 beginning balance is end balance of year 1. Year 2 beginning balance is end balance of year 1. Then year 2 interest, beginning balance multiplied by effective interest rate. Effective interest rate. So year 2 interest 83. Year 2 company pays coupon. Company pays 100 coupon. Then year 2 cash flow 100. Then year 2 end balance. Beginning balance plus interest minus coupon payment. You get the end balance. End balance 1058. 1058. So this 1058 is your debenture liability. This 1058 is debenture liability. And second year interest is 83. This 83. So this 83 goes to profit and loss. 83 goes to profit and loss. And you can check this 1058. So this should be equal to the present value of future cash flows. Now we are at the end of second year. You see, we are at the end of the second year. Now what are the future cash flows? Third year cash flow, fourth year cash flow, and fifth year cash flow. So these are the future cash flows. We are at the end of the second year. Future cash flows are third year, fourth year, and fifth year cash flows. So future cash flows, third year 100, fourth year 100, and fifth year 1100. 1100. Now you can find the present value. Present value of these future cash flows. Rate is 7.76. Values are these three values. You see 1057. 1057. Now you see it's equal to 1057.97, almost 1058. Equal to the debenture in value. Debenture value. Debenture value at the end of the second year. You see, we have taken to the financial statement 1058. 1058. Now you see this is equal to the present value of future cash flows. Present value of future cash flows at the effective interest rate. At the effective interest rate. Right. Now the learning point is this. So if the company has correctly followed IFRS 9, then your debenture liability represents present value of future cash flows. So that value is acceptable for your analysis. So if the company has not followed IFRS 9, then your debenture value is not acceptable value for your analysis. Right. So that's your learning. So similarly, you can complete year 3, year 4, and year 5. can complete the rest of the 3 years. Right. So interest are equal to beginning balance multiplied by effective interest rate. Then payments, third year payment 100, fourth year payment 100, but fifth year 1100. Right. Now you see at the maturity, debenture value becomes 0. You see, at the maturity, the value of your debenture is 0. The meaning is you have paid back to the investors. Then there's no value in your financial statement. Right. Now this is how debentures should be recorded in the financial statements. Right. So if you have any question, you can ask. Then let's see another liability, leases. Leases. For leases, you have to apply IFRS 16. So you have studied this. So by this time, you should know this. IFRS 16. Right. So if you haven't read this standard, studied this standard, now this is your last opportunity, because after this semester, you are going to the industry. You have the industrial training. Thereafter, you are continuously in the industry. Then if you don't know about accounting standards, you don't have any value in the industry. Right. So you should continuously update your standards. Standards are revised time to time. So you should keep in touch with those updates. Then only you can have a good value. You will get various opportunities. Right. Right. Now we'll have a brief idea about leases. Lease is a transaction between these two parties, lessor and lessee. So lessor is leasing company. Lessee is the use of the asset. So the leasing company the lessor gives the lessee right to use the asset. Lessor gives the lessee right to use the asset for a particular time period. In return, lessee has to make the payments. So lessor gives the asset to lessee for a particular time period. In return, lessee has to make the payments to lessor. So those payments we call lease payments or lease interest. Right. Now you see, lessor gives the asset the right to use the asset. That's very important. Lessor gives the lessee the right to use the asset for a particular time period. Then lessee gets control over the right to use the asset. In return, lessee has to pay lease rental. Lease rental. Right. So this is the nature of a lease. Now we are looking at from lessee's point of view, because this is a liability from lessee's point of view. The user's point of view, a lease is a non-current liability. Non-current liability. So now we are going to see from lessee's point of view. Right. Right. You know this. So we have to apply IFRS 16. So in the IFRS 16, you find this model, right of use model. So you have to account the lease according to this right of use model. This is standard effective from 1st January 2019 onwards. Right. Earlier we had LK 17. Now this LK 17 is superseded by IFRS 16 or SLFRS 16. Right. So you have to apply now SLFRS 16. Right. So let's see a simple example. So with this example, we'll see how leases are accounted or present in your financial statements. Now you see this example. You see a APLC obtain a motor vehicle on following lease terms in the financial year ending 31st March 2009. Right. So this is the first year of your lease. Financial year ending 31st March 2019 is first year of your lease. Now you see the lease terms and conditions. Annual rental is 20,800, payable at the end of the year for 8 years. The cash purchase price of the asset is 80,000. And useful life is 10 years. The interest rate implicit in the lease, 20%. Interest rate implicit in the lease, 20%. Now we'll study how this lease transaction should appear in the financial statements. Right. So you have to prepare lease amortization schedule. You know this. So we'll see that you have studied this. Right. So lease period is 8 years. Lease rental 20,800 for 8 years. Interest rate 20%. So we'll prepare amortization schedule. Year beginning balance, interest, lease rental or lease payment, then capital repayment, then you have end balance. So first year is 2019. Year ended 31st March 2019. Right. So remember the beginning balance. You should initially record the lease at present value of lease cash flows. Now, what are the lease cash flows? You see, lease cash flows are over 8 years. These cash flows are over 8 years. Right. How much lease cash flows? 20,800. So annually you have to pay 20,800. 20,800. Now this is annuity. So you get the present value of this annuity. You get the present value of this annuity. Or you can calculate NPV. Interest rate 20%. You see lease interest rate 20%. And these are the values. These are the values. So present value of these cash flows. Present value of these cash flows. 79,830. Right. So don't go and calculate manually. That's useless. So you practice every time with Excel. Because this is the what? This is the knowledge you bring to bring for your practical training. This is what the way you do in practice. Right. So when you go for a practical training or when you are working, hardly you will write down something with a pen. Every time you work with computers. Whatever the calculation you have, you do with Excel, at least. Hardly you work with pen and papers. Right. Now you see, these are the lease cash flows. Present value of these cash flows, 79,830. So this is the value, the lease the value of the lease that should be recognized initially. So your lease beginning balance 79,830 beginning balance. Then interest beginning balance multiplied by 20%. You see implicit interest rate 20%. Beginning balance multiplied by 20%. Lease rental, 20,800 lease rental. Now you see, you pay rent, total rent 20,800. That includes interest 15,963. Then the balance is capital repayment. Balance is capital repayment. So capital repayment equal rent minus interest. Rental, lease rental minus interest. You pay the leasing company 20,800. That includes interest. Then capital repayment is 4,837. Then end balance equal beginning balance minus capital repayment. End balance equal beginning balance minus capital repayment. Right. You see end balance 74,976. $74,976. Now we'll see how this lease comes to your financial statement. So we'll see how this lease comes to your financial statements. Right. So in the first year, now we are in the first year of the lease, the interest goes to the profit and loss under finance cost. The interest is 15,963. So in the first year, in the statement of income under finance cost, interest 15,963. Then in the statement of financial position, the lease liability, this 74,000 is 74,976. In the statement of financial position, lease liability 74,976. Right. Again, this is equal present value of future lease payments. Now we are at the end of the first year. Then future lease payments are second year, third year, fourth year, up to eighth year lease payments. So we are at the end of the first year. Then these are the future lease payments. These are the future lease payments. Second year to 8th year lease payments. Then how much present value? How much present value of these lease payments? So you can calculate NPV. The rate is 20%. Values are from second year to 8th year. You can calculate NPV. Interest rate 20%, 0.2. Then the cash flows are from year 2 to year 8. Second year to 8th year. How much? Present value 74,976. That's equal to the lease liability in your statement of financial position. Right. Now you see here your lease liability recorded at present value. You see, lease liability is recorded at present value. Lease liability represent present value of future lease payments. Right. In addition, this liability you have to separate into current and non-current liability. This lease liability you have to separate into non-current liability and current liability. So how much lease liability under non-current liability? How much lease liability under current liability? You have to separate into non-current liabilities and current liabilities. So this 74,976, you have to separate into current and non-current liability. Right. So how you are going to do that? So from this total liability, amount payable within the next year is current. Then balance is non-current. From this total liability, amount payable within the next year has to be current liability. Then balance has to be non-current liability. So how do you separate these? You can calculate the next year interest and capital repayment. So we'll continue the table to the next year. Next year beginning balance, first year end balance. Then interest, beginning balance multiplied by 20%. You continue the table to the next year. Continue the table to the next year. 2019 end balance is 2020 beginning balance. Then 2020 interest is beginning balance multiplied by interest rate 20%. Lease rental is the same, 20,800. Then how much second year capital repayment? Out of 20,800, interest is 14,995. Then balance is next year capital repayment. The balance is next year capital repayment. Now you see, from your total liability, now you are at the end of the first year. From your total liability, 74,976. Within the next year, you have to pay 5,805. 5,805. You see again, from your total liability, 74,976. Within the next year, you have to pay 5,805. 5,805. Therefore, this 5,805 is current liability. 5,805 is current liability. Then the balance from 74,976 deduct 5,805. The balance comes to 69,171. It's non-current liability. Non-current liability. Right. So company has to present separately from the total lease liability how much current and how much non-current liability. Now you have to check your financial statement whether the leases have been presented according to SLFRS 16. Now let's see the second year. So second year capital repayment, 5,805. Then second year end balance equal beginning balance minus capital repayment. Beginning balance minus capital repayment. So we'll complete we'll continue this table to the next year, 2021. That's the third year. So beginning balance, 2021 beginning balance equal 2020 end balance. Then interest is equal to 20% of beginning balance. Interest rate 20%. 20% multiplied by beginning balance. The rental is 20,800. Now you see out of 20,800, the interest is 13,834. Then the balance is capital repayment. Balance is capital repayment. Now you see second year in 2020. Second year is 2020. You see end of the second year, the lease liability 69,171. You see 2020, end of 2020. Lease liability 69,171. This is total lease liability. Then how much current liability? Out of 69,171, within the next year, you have to repay capital repayment 6,966. Out of this total, within the next year, you have to repay capital repayment 6,966. Then this 6,966 is current liability. Then the balance is non-current liability. Out of 69,171, deduct 6,966 current liability. you get balance 6,200, 62,205. 62,205 is non-current liability. Then the interest for the second year, you see a 14,995 goes to profit and loss. 14,995 goes to profit and loss. Right. This is how your financial statement or how this lease transaction should be presented in financial statement. Now, when you're analyzing lease liability, you check whether the lease transactions have been presented accordingly. Interest goes to profit and loss. Then the lease liability has to be divided into current liabilities and non-current liabilities. Right. So you have to check whether the company has recorded lease liabilities accordingly. Any questions? Right. Any questions? Now let's see another example. So in your study material, exercise number 2. In your study material, exercise number 2. You see exercise number 2. At the beginning of the year 2019, a building was obtained on following lease terms. Now you see there's a lease transaction. Lease period 12 years. Annual lease rental, you see, they are not fixed. Annual lease rentals, you see, vary from year to year. Now you have all 12 years rent, annual lease rent. Then implicit interest rate on lease 5.8%. 5.8%. These lease rentals are currently recognized in financial statements as an expense. Now this is wrong. So you can't record entire rent as an expense. Only the interest part has to be expense, and there should be lease liability. So this accounting treatment is not acceptable for your analysis. This accounting treatment is not acceptable for your analysis. Only the interest part has to go to a profit and loss. as an finance expense. In addition, there should be a lease liability. That liability has to be classified under both non-current and current liabilities. Now you see, a company has not followed SLFRS 9 or IFRS 9. Now you have to do the relevant adjustments. So here you see company has not followed IFRS 9. So if you see the next page, you see a 2019 financial statements. You see 2019 financial statements. Now these financial statements has to be adjusted. These financial statements has to be adjusted. Right. Now let's see the adjustments. Right. So you can take these financial statement first to Excel worksheet. You can copy and paste values. You take these financial statement first to an Excel worksheet. Then we'll see the adjustments. Right. Quickly take this financial statement to an Excel worksheet. So we have statement of income. Statement of income. So you have sales, $24,547. Then operating expenses, $23,243. Then operating income, or you can say operating profit. Operating profit, sales minus operating expenses. Right. So operating profit. Then interest expense, interest expense is 8. Then you have profit before tax. Profit before tax. Then income tax. income tax 496. Then recurring income. So here recurring income given because company has discontinued operations. So we'll be studying those discontinued operations in the next lesson. Right. So recurring income. $800 discontinued operations. Discontinued operations. There's a loss 95. So company discontinued operation because it's loss making. Those operations are loss making. Then company's profit for the year. Profit for the year. $800 minus 95. 800 minus 95. So these values are given values. So you can write down values as given. For values before the adjustment, you can say values as given, or you can say values before adjustment. Before adjustment. Values before the adjustment. Right. Then statement of financial position. Statement of financial position. We have non-current assets, 2,928. Current assets, 5,724. Then total assets, equity, 3,422. And current liabilities, 729. Current liabilities, 4,501. Then total equity and liabilities. Total equity and liabilities. Right. Now these are the financial statements as given. Or you can say financial statements before adjustment. Right. Then we have next column for adjustments. Next column represents adjustments. Then to these values, you do the adjustments. you get the adjusted values. Adjusted values or adjusted financial statements or values after adjustments. Now, this is what you are going to use in your analysis. So in your analysis, you are going to use those adjusted values. You are going to use those adjusted values. Right. Now let's see what adjustments you have to do here. Now you back to the question. Back to the question. Now you see lease rentals are currently recognized as an expense. So that's wrong. This is wrong. You can't recognize lease rental as an expense. So you have to remove from the expense. You have to remove lease rental from the expense. Right. Now we are in the first year of the lease because these financial statements are for 2019. These financial statements are for 2019. So we are in the first year of the lease. Financial statements are for 2019. Now how much first year end? First year end 454. You see the question? First year end 454. So that's included in the operating expense. So 454 you remove from the operating expense. You remove from the operating expense. So under adjustments from operating expenses, you deduct 454. Then how much? The revised value or adjusted value. Adjusted value 22,789. 22,789. So we have removed from the operating expenses. Now you have to bring the lease to the financial statements according to SLFRS 60. So you have to bring the lease to financial statement according to SLFRS 60. You don't need to pass double entries. You can easily do this if you prepare amortization schedule. So we prepare amortization schedule. We'll prepare amortization schedule. Lease amortization schedule.
Bani mam passe mukkaran passe mukkaran.
Right. You prepare lease amortization schedule. So here, beginning balance, interest, lease rent, rental, then capital repayment, then you have end balance. So you can quickly prepare this. So we are in 2019, that's first year. 2019 is first year. So how much beginning balance? How much beginning balance? Beginning balance equal to present value of lease rent. Beginning balance equal to the present value of lease rent. Now you see the question. You see a lease rental for 12 years. You can separately calculate present value of lease rental. Right. So lease is for 12 years. You take the 12 years rent. So take the 12 years rent. So this 379 is from 5th year to 11th year 5 to 11. Then last year, 12th year, 347. 347. So these are the 12 years rent. Interest rate on lease 5.8%. Now you have to take the present value of these rent at 5.8%. Right. You can calculate NPV. NPV. NPV, the rate is 5.8%. 5.8%. Then values are these. Values are these. Right. So how much? Present value of this rent, 3,322. Present value of this rent, 3,322. So this is a beginning balance of the lease. 3,322. Beginning balance of the lease. Then interest, 3,322 multiplied by 5.8%. 5.8%. So interest for the first year, 193. First year rent, 454. First year rent, 454. Now you see out of first year rent, interest is 193. You see out of first year rent, interest is 193. Then the balance is capital repayment. So rent minus interest you get capital repayment. Rent minus interest, you have capital repayment. Then end balance, beginning balance minus capital repayment. End balance is beginning balance minus capital repayment. So lease end balance 3061. So this is lease liability at the end of the 2019. This is your total lease liability at the end of 2019. 3061. 3061. Now this has to be separated into current and non-current. This total liability, you have to separate into current and non-current. Right. Now for that, you have to continue this table to the next year. So let's work out for 2020. 2019 end balance is 2020 beginning balance. Interest, this beginning balance 3061 multiplied by 5.8%. This beginning balance multiplied by 5.8%. Second year rental 424. Second year rental 424. Now you see out of 424, interest is 178. Then balance is capital repay. 424 minus interest. You see balance 246 capital repayment. Now you see out of first year end balance, within the next year you have to pay 246. You see out of 2019 end lease liability 3061. End of the first year, sorry, within the next year, you have to repay 246. So this is your current liability. This is your current liability. 246. Then the balance is non-current liability. The balance is non-current liability. Right. Now let's take this lease transaction to your financial statements. Now we are adjusting 2019 financial statements. We are adjusting 2019 financial statements. Interest 193. Interest, lease interest 193. So you have to take to the finance cost. So in your statement of income, this 193, you have to take to the interest expense. This 193, you have to take to the interest expense. Then how much total interest expense? 8 plus 193. 8 plus 193. The interest expense is 201. 8 plus 193, 201. Then we have to take the lease liability. Total liability at the end of the first year, 3061. Out of that, 246 is current liability. Then under current liabilities, adjustment 246. Under current liabilities, 246. Then total current liabilities, 4,501 plus 246. Total current liabilities 4,747. 4,747. Then the balance is non-current liabilities. You see total liability 3,061. You deduct 246 current liability. Then you get balance. That's non-current liability. How much? Non-current liability 3,061 minus 246. Then non-current liability 2,815. Then adjusted value 729 plus 2,815, 3,544. 3,544. Now you see we have adjusted interest. We have adjusted liabilities. Then we have to bring the lease asset. Under non-current assets, you have to bring the lease asset. You have to bring the lease asset. How much lease asset? You see beginning value 3,322. You see beginning value 3,322. So you have to bring the lease asset 3,322. Then from that you have to deduct depreciation. So you have to take the depreciation adjusted lease asset. Lease asset beginning value 3,322. Then deduct depreciation. You have to deduct depreciation on this building. So let's say you follow straight line basis. Then how much depreciation per year? Now you see asset is available for use 12 years. You see you can use building only for 12 years. Then straight line depreciation, asset value 3,322 divided by 12. So depreciation equal 3,322 divided by 12. You have to take the depreciation adjusted value. You have to take the depreciation adjusted value. Asset value 3,322. Asset value 3,322. Then minus depreciation 3,322 divided by 12. How much? Annual depreciation? Annual depreciation. You can calculate depreciation. 3,322 divided by 12. 277. You can take 277. So depreciation adjusted value 3,322 minus 277. So non-current assets now 5,973. Non-current assets 5,973. that 277 depreciation has to be in the profit and loss account. That 277 depreciation has to be under operating expenses. So we have another adjustment to operating expenses. We have another adjustment. $277 depreciation. Depreciation 277. 454 is lease rental. So 454 we have removed from the operating expenses. Then 277 depreciation will have to add to the operating expenses. 277 depreciation you have to add to the operating expenses. You need to add to the operating expenses. Now you see adjusted operating expenses 23,066. Adjusted operating expenses 23,066. Right. So these are the adjustments. Any questions? You see, we have removed the rental charge to the profit. We have removed the rental charge to the profit. Then interest we have taken to the profit and loss. Depreciation we have taken to the profit and loss. We have recorded the lease asset and lease liabilities. Right. Now we'll calculate the adjusted values. Before that, if you have any question, you can raise. You can raise now. Sales, there's no change, no adjustments. To the operating expenses, we had 2 adjustments. Then we got the adjusted value. You can calculate operating profit now. Adjusted operating profit, 1,481. Adjusted operating profit, 1,481. Then interest expense deducted. Interest expense deducted. Then profit before tax, 1,280. Profit before tax, 1,280. Then you have to adjust income tax. You have to adjust income tax. Now you see, before the adjustment, profit before tax, 1,296. But after the adjustment, profit before tax, 1,280. Now you see profit decreased by 16. You see net effect to the profit. Before the adjustments, 1,296. But after the adjustments, profit comes down to 1,280. Profit before tax, you see, it has come down to 1,280. Now you see, as a result of these adjustments, your profit before tax decreases by 16. You see net effect to the profit. You see it decreases by 16. Decreases by 16. You know, when the profit decreases, your tax expense has to be decreased. You see, lower the profit, lower the tax. When the profit gets lower, your tax expense will decrease. Now you have to calculate the tax effect. You have to calculate the tax effect. Now for that, remember, you don't take corporate tax rate. So what we do here is, you calculate effective tax rate. Right? We can calculate it. Effective tax rate. So after the statement of income, we can calculate here effective tax rate. Effective tax rate. After the statement of income, you calculate effective tax rate. So it's very simple. Your tax expense divided by profit before tax. Effective tax rate equal tax expense divided by profit before tax. Tax expense is 496. And to make it positive value, minus 496. Minus, you can link this cell, divided by profit before tax. Profit before tax. You see effective tax rate. Now let's see the percentage. Let's see the percentage. 38.3. Effective tax rate 38.3. Now by using this effective tax rate, you can adjust the tax effect. You can calculate the tax effect. Now you see the change in the profit. Before the adjustments, profit is 1,296. After the adjustments, profit comes down to 1,280. You see profit declines by 16. Then tax effect is 16 multiplied by effective tax rate. The tax effect is 16 multiplied by effective tax rate. You see tax effect is 6. Tax effect is 6. Your tax expense has to be decreased by 6. Because you know when the profit decreases, the tax expense has to be decreased. When the profit decreases, tax expense will decrease. Now you see your income tax expense should be decreased by 6. Now it is 496. Then adjusted income tax expense is 496 minus 6, 490. Adjusted income tax expense 490. Then profit after tax 1,280 minus 490, 790. Discontinued operation, no adjustments now, but we'll be studying later on. There are some adjustments to the discontinued operations. So we'll study in our next lesson. Then profit for the year, adjusted profit for the year, 490 minus 95, 695. So this is your adjusted profit. Adjusted profit. Now you see income tax expense decreases by 6. Your tax liability also decreases by 6. You see income tax expense decreases by 6. That impact your tax liability. When the expense decreases by 6, your tax liability decreases by 6. So current liabilities. Now we have another adjustment. So we have adjusted that lease rent 246. We have adjusted lease rent 246. In addition, you have to adjust the tax effect 6. This 246 is related to the lease. This 246 is related to the lease. Then you have to adjust tax effect. Your tax expense, tax liability decreases by 6. Therefore, current liabilities decreases by 6. So minus 6. Then adjusted current liabilities 4,741. Before the adjustment, 4,501 plus 246 minus 6. 4,501 plus 246 minus 6. Right. Now you see, after all these adjustments, you see the change in the profit for the year. Before the adjustment, profit for the year 705. You see, before the adjustment, profit for the year 705. After adjustment, profit for the year 695. You see, profit decreases by 10. So this is net effect to the profit. Profit decreases by 10. Profit decreases by 10. So when the profit for the year decreases, your retained earnings decreases. When the profit for the year decreases, retained earnings decreases. Retained earnings included in equity. So the equity value has to be decreased by 10. Equity value has to be decreased by 10. Now we have adjustment to equity value. We have adjustment to equity value. So this equity value has to be decreased by 10. Then adjusted value 3,422 minus 10. 3,422 minus 10. Right. So every time after doing all the adjustment, you see the tax effect. You have to adjust the tax effect using the effective tax rate. Using the effective tax rate. Then you see the net change in the profit. You see the net change in the profit. So that change in the profit has to be adjusted in the retained earnings. You first adjust the tax effect. After all the adjustments, you find the tax effect. Then tax effect, you have to adjust through effective tax rate. So you find the tax effect by using effective tax rate. Then tax effect, you have to adjust to the income tax and tax liability. Then you find the net change in the profit. The net change of the profit, you have to adjust to the retained earnings. You have to adjust to the retained earnings. Right. Let's see now adjusted value of your assets and liabilities. Non-current assets, we got the adjusted value. Then current assets, there is no adjustment. Then total assets, 11,697. Total equity and liabilities, total equity and liabilities, 11,697. Now remember, total asset is not necessarily be equal to total equity and liabilities after doing the accounting adjustments. There are situations this will be equal. There are situations with certain adjustments. Your total assets may not be equal to equity and liabilities. We could remember with the inventory example. But here total assets equal to equity and liability. Any questions? Any questions? Now we have adjusted values. So we are going to use these adjusted values in the analysis. Right. So we do ratio calculations, common size analysis, trend analysis. So all the analysis you'll have to do with adjusted values. Right. Now we studied financial liabilities, particularly borrowings, debentures, and lease liability. In addition, there can be contingent liability. So you have the idea about contingent liability. It's a possible liability. The occurrence depends on certain uncertain future events. So usually these contingent liabilities are not recorded in the statement of financial position. They are simply disclosed in notes. But there can be situations, some contingent liabilities become a real liability. There can be situations, some contingent liability becomes a real liability. Now, for example, let's say a customer has filed a case against your company. The customer says you have provided damaged products that badly affected their operations. Let's say individual customer says you have sold damaged product or expired products. Because of that, now the customer become ill. Now customer is hospitalized now. So family members of that customer has taken legal actions against your company. So by the financial year, let's say the case is in progress. So you have recorded as a contingent liability. So after some time, the case will be settled. So you may become liable. You may become liable, or you will have to pay some compensation. Right. Then your contingent liability becomes a real liability. Then you have to record that liability in your statement of financial position. Now you see there are situations your contingent liability becomes real liability, true liability. So when that happens, you have to bring that liability to statement of financial position. So in the accounting analysis, you have to observe whether such situations are there with the company. So you have to study the company's contingent liabilities. You can find them from the financial statement notes. All the material contingent liabilities are disclosed in the financial statements. This is a requirement in the accounting standards. All the material contingent liabilities have to be disclosed in the financial statements. So by reading the financial statement notes, you can find companies' contingent liabilities. Then you have to study with the company's additional information whether these are actual liabilities or not. So if you are an internal analyst, you can discuss with the top management. You can discuss with company lawyers and get more information about those contingent liabilities. Then you can apply your judgment whether these are actual liabilities. There can be situations the company's contingent liabilities becomes actual liabilities. Then those liabilities has to be recorded in the statement of financial position. So contingent liabilities are only in the notes. When they become actual liabilities, they have to be recorded in the statement of financial position. Right. So you have to analyze and see whether such reclassification is required. Whether certain contingent liabilities has to be taken to the statement of financial statement of financial position as actual liability. So you have to analyze relevant information and see such reclassification is needed. Right. Right. So these are about liabilities. So later on, we'll discuss about equity. Now we'll move on to the tutorial. So in the LMS, you can see the tutorial. Tutorial number 4. Tutorial number 4. Right. So here you see consolidated financial statements of XPLC. So usually we take consolidated financial statement in the analysis, right? So we are not only analyzing the parent company, we are analyzing the entire group of companies. So we normally take consolidated financial statement for the analysis. In your assignment, you should follow the same, right? You take, so if you have both companies and consolidated financial statements, you take a consolidated financial statement. So if you see only the company's financial statement, then you have to take company's financial statements because there is no group. If there's a group of companies, if your selected company is a parent company, if your selected company is a parent company, then there's a group of companies. Then you see in the annual report both companies' financial statements and consolidated financial statements. Now you should know by now, you should know whether your company has a group of companies. Because you have studied over 3 weeks, you have studied about your company. So by now, you are more familiar with the nature of the company. You know more, where you know well, you know very well about your company. So if your company is a parent company, then you find both company's financial statements and financial statements of the group. So if that is the case, you should take consolidated financial statement. Right. Now you see you have consolidated financial statements for 3 years. You have statement of income, statement of financial position, and some additional information. Right. Now you see the first one. You see additional information number 1. So number 1 is about a lease. Now you see the lease is on motor vehicle. The cash price is 1.5 million. You see lease payments annually, 416,150. You see your financial statements are given in thousands. You see financial statement values are in thousands. Then you can do all the adjustments in thousands. You can do all the adjustments in thousands. Right. So in thousands, lease rent is 416. Lease rent is 416, payable on 31st March. You see lease rent is payable annual. Interest rate implicit in the lease 12% per annum. Useful life of the motor vehicle is 6 years, but lease period is 5 years. You see, you have to pay 5 annual lease rent. You have to pay 5 annual lease rent. So you have to depreciate the asset over 5 years. You have to depreciate the asset over lower of the useful life and lease period. So you have to depreciate over 5 years. Then you see lease payments have been classified in the financial statements as operating expense. Now you see, lease payments are recorded as operating expense. Lease payments are recorded as operating expense. So this is wrong. According to SLFRS 16, this accounting treatment is not acceptable. Therefore, this accounting treatment is not acceptable for your analysis. Now you have to do the relevant adjustments. Then you see number 2. On 1st April 2020, XPLC issued 5 million debentures for rupees 5,250,000. You see nominal value 5 million. But issue price is 5,250,000. You see debentures are issued at a premium. These debentures mature in 5 years. The premium has been recorded under reserves. You see the financial position. You see the financial position. You see under equity, debenture premium. So company has recorded debenture premium under equity as a reserve. You see a debenture non-current liability is 5 million. So company has taken nominal value of debenture as a liability. Right. Now you see. So what the company has done is the nominal value of debentures are in the non-current liability. The premium has been taken to the reserves. Can you accept this for your analysis purpose? Can you accept this for your analysis purpose? You can remember, for your analysis purpose, you have to take the non-current liabilities at present value. You see, for the analysis purpose, your non-current liabilities should be at present value. But you see, debenture liability is at nominal value. You see, debenture liability is at nominal value. Therefore, this debenture liability you cannot use for your analysis. And you see the debenture transactions are not according to the recording is not according to IFRS 9. Company has not followed IFRS 9 here. If the company had followed IFRS 9, your debenture liability would be at present value. Now you see, company has not followed IFRS 9. That's why you see debenture value at nominal value. Debenture value at nominal value. Right. Now you have to do the relevant adjustments. Then number 3 about long-term loan. You see, bank loan of 400,000 obtained on 1st April on the following terms. You see, grace period 12 months. So what is the meaning of grace period? So this is a concessionary period. Now during this grace period, in this example, company doesn't have to repay the loan. You see, you got loan on 1st April. Then the first year is grace period. So during the first year, company doesn't have to pay anything. You see, thereafter, you see number 3, thereafter, the repayments are annual. That means from second year onwards, company has to repay the loan. You see, repayments are annually at 100,000 plus interest. 100,000 plus interest. You see, annual capital repayment 100,000. Interest in addition to capital repayment, you have to pay interest. You see, repayments over a period of 4 years. Implicit interest rate is 12%. The loan interest rate 12%. Correct. Now here you take only the interest rate, loan interest rate, not implicit. You write down loan interest rate is 12%. Loan interest rate is 12%. Right. Loan interest rate is 12%. You erase the word implicit. You write down loan interest rate is 12%. Right. Then for this third one, you see whether now this is a financial liability. Bank loan, financial liability. Like debentures, bank loan is a financial liability. You see whether company has followed IFRS 9 or SLFRS 9. So if the company has followed SLFRS 9, then your loan value at present value. If not, you should adjust the financial statements. If not, you should adjust the financial statements. Then number 4, it's about guarantee. Number 4 is about guarantee. So your company has guarantee import loans of ABC PLC. Now ABC PLC become bankrupt. Now when you provide a guarantee to a third party, that guarantee is a contingent liability. But here you see that third party, ABC PLC became bankrupt. Now you have guaranteed the loans. Now ABC PLC became bankrupt. So ABC is unable to repay the loan. Then you are liable to repay because you have guaranteed the repayments. Now you are liable to repay the loan. Now you see that contingent liability becomes actual liability. You see once again, number 4. You see once again, number 4. So this company has guaranteed import loans obtained by ABC. So that guarantee is your company's contingent liability. Because you will have to pay the import loans if ABC doesn't pay. When ABC doesn't pay import loans, you will become liable. You will become liable to pay loans because you have given a guarantee. Now you see what happens here? ABC bankrupt. Therefore, unable to settle import loans. 500,000. Now you see, ABC cannot pay import loans. ABC cannot repay the loans. Then you will become liable for that. You will become liable for that. Now you see that contingent liability becomes actual liability. The company's contingent liability becomes actual liability. You see, bank has taken legal action to collect loan outstanding from the guarantor. Then number 5, company changed the depreciation method from reducing balance to straight line basis. Right, we discussed that. So when the depreciation method change, you see your financial statement become, or financial statements are not comparable. You see for certain years, one basis, for other years, another basis. You see the changes in 2021. Then 2019 and 20, depreciation on reducing balance basis. 2021, depreciation is on straight line basis. Now you see the old financial or 3 financial years are not comparable. So you have to bring all 3 years to one basis. You have to bring all 3 years to one basis. Right. Then you have notes to the financial statements. Expense notes are there. Right. So you can try question A and question B. You can try question A and B. So you have to prepare adjusted financial statements. You have to prepare adjusted financial statements. Right. you see in your LMS, so I have given a worksheet. You see, you can download that worksheet. This is your worksheet. Right. Now, these are the financial statements. Right. So you can have this sheet financial statements. You can rename this sheet financial statements. Then you can have another sheet to prepare adjusted financial statements. So you can have the name adjusted financial statements. You can have the name adjusted financial statements. So what you can do is you copy the line items. You copy and paste here line items. Line items. Then you take, let's say you take 2021 first. 3 columns for 2021. So one column is before adjustment. Before adjustment. Another column adjustment. Another column after adjustment or adjusted value. Adjusted value. Right. So likewise, you can apply the same for rest of the 2 years. For 2020, before adjustment. So you have 3 columns for 2020. (2023) columns. Again, the columns heading are before adjustment, adjustment. Then you get the adjusted value. Then same for 2019. 2009. Right. Same for 2009. So before adjustment values are the given values. You can take these values. Values before adjustments are the given values. Then you read additional information. You can do the relevant adjustments and find the adjusted value. Right. So within the next 2 days or tomorrow, you can try this. Then day after tomorrow, we have the lecture from 8 to 10. We can quickly finish this, right? Because I believe you will come with the answer. Right. And we have studied the lesson. We have completed the lesson. So you can answer this question. You can answer this tutorial. So you come with the answer. Then we can quickly finish this tutorial. Right. So when you come with the answer, you need to just check your answer. You don't need to work out with me. You just need to check your answer. If there are some mistakes in your calculations, or if you have not correctly done the adjustment, you can note down. Right. So we'll quickly finish this tutorial. So come with the answer next time. Thursday, day after tomorrow. Then we'll discuss the answer and move on to the next lesson. Right. So that's all I have planned for the today's class. Any questions? Any question you have? Right. Then see you next time.
Thank you, sir.
You're welcome.
Thank
Thank you,
you,
sir.
sir.